How do you validate you're using the correct go-to-market motions? Let's do a GTM checkup in this week's episode of Closing Time. Thanks for tuning into Closing Time, the show for go-to-market leaders. I'm Val Riley, head of content and digital marketing at Insightly CRM. Today, I'm joined by Chris Brack. He is CEO of MRP, a demand generation firm. Thanks for joining us today, Chris.
Awesome. Good to be here, Val.
Great. Chris, when we think about the common go-to-market motions, I think people would mostly agree the popular ones are product-led, inbound-led, perhaps outbound-led. Which have you run in your career with success, and which do you find to be a little more challenging?
Most of my career have been, I wouldn't call it an outbound-led or a sales-led motion. Given the industries that I've worked in, we have I don't want to say a fairly finite TAM, but a very focused group of maybe 4,000 companies that we know are generally a great ICP fit for what we do. So, it's difficult to drive a lot of inbound, right, with a very specific or focused TAM like that. So, but if you know who's buying, where they're buying, and how they buy, and how often they buy, an outbound motion generally fits really, really well there. So most of my experience has been out loud and sales led. We've always liked to pair that with a bit of inbound, just to kind of try to find that capture versus generate, because there are obviously marketers in market buying.
Right. Totally agree. In our case, we're in the CRM business, which is highly competitive. So inbound can be challenging, but we're lucky that we have like a super intuitive product, so we can lean on product-led growth a little bit. So I would say, would you agree that, depending on your vertical, depending on your market, you really have to kind of pick and choose which ones are the right fit?
Yeah, I think in most verticals and markets, a hybrid works in some form or fashion, right? There's always going to be a couple key motions that you're likely going to lean on, like a primary and then maybe one or two, subsidiaries, because just, all eggs in one basket is tough no matter what you're doing. Product-led I found to be probably the most challenging, right? Because again, to be candid, building really, really great products enough to where it attracts a high volume of folks without a lot of outbound work isn't easy to do, right? I can count on maybe this many fingers, companies that have really done it well. Your Atlassians, your Slacks. Okay, I'm running out already, right? So like it's people think that like, oh, if you build it, they will come, or if you create a freemium, people are just going to magically show up to your website, and it just doesn't usually connect that way. So I found that product-led is probably the most difficult, but obviously the most attractive given the cost, the different cost analysis over time from a cost of acquisition standpoint.
Absolutely. The Dropbox example, everyone loved to talk about that, 10 years ago. And unfortunately, there aren't that many Dropboxes out there, right?
Yeah. And let's not forget the amount of the amount of actual dollars that Dropbox put into the market to drive that volume for their free 5 gig offering, right? Like they were burning and churning millions each month, on their go-to-market motion, just to get to the point where they finally reached that bridge of profitability that they could cross over. But I mean, not a lot of companies have hundreds of millions of dollars of funding as a runway to fuel that type of go-to-market. And two, a lot of investors don't have the patience anymore. So it's an interesting play, but again, the amount of marketing muscle that goes behind a true product-led motion on a freemium side is usually larger than most executives know going into it.
Absolutely. That patience is a key thought there. So let's say you're in a startup. Realistically, how many go-to-market motions can the typical startup be running? And I'm thinking of a startup, maybe you're 20 people or less.
I would say 1.2, right? Your primary go-to-market with again a something else that's you're working on, right? Like something that you're perfecting and something else that's like in the hopper for the next round. And as an example would be, your primary go-to-market might be a channel or a partner focused play out of the gate because you don't have a large selling organization. So you have one really great seller who's great at connecting into the channel, but your 1.2 is figuring out how you're speaking to the end customer for when you eventually, bypass that into a general, go directly to customer stream versus the channel. Or again, you're heavy outbound, but you're slowly starting to test and build up your credibility with Google to start driving inbound and understand the cost metrics that associate with that. So I would say at that level, when you're a very early stage startup, it's hard to do more than one, right? You can't boil the ocean because you just don't have the people power to drive it. But working on one that's like your primary while you're thinking and driving towards that second, and then obviously third, and obviously, till you get to the point where you're a robust organization and you have 4 or 5 active go-to-markets happening at the same time.
I love that answer. 1.2. It's indicative of the startup life. You always have something else that you've got in the back of your mind. So that's a great answer.
It's like a side hustle.
Yeah.
Yeah.
Your second go-to-market motion is your side hustle. I love it. So let's say you're a little bit more of a mature business. You've got 2 or 3 go-to-market motions going. I think a lot of businesses would be like, okay, great, set it and forget it, right? The outbound's working, the inbound's working. Maybe we are doing a little bit of community-led growth or whatever. So we're good. But you might say that's a mistake.
Just look at how much the world has changed over the past 3 years, right? You had COVID turn the world on its head. You had a post-COVID technology boom driven by low interest rates and a lot of free capital and almost free money hitting the market, driving a massive amount of investment. And then you hit the top of that and everything fell off a cliff, right? So if you're using the same go-to-market you were using in 2020 or 2021 or 2022, there's no way it's working. And unfortunately, a lot of leaders are finding that out the hard way right now. If you're an inbound driven go to market, there's less companies in market. So your cost per acquisition and all of your paid acquisition inbound are significantly higher and you're not driving enough volume that you could. If you're an outbound motion, there's infinitely more buyers in the market, sellers in the market, automation, generative AI, driving higher volumes of emails, higher volumes of LinkedIn message, all of that's just creating so much noise that makes the average, I would generally put a 6-month go-to-market evaluation touch point in the ground, right? Like what are we doing? Is it working? Is there something else 1.2 when we can start thinking about? Is there something new that we haven't heard about that other folks are kind of jumping into? Like 3 years ago, I don't think anybody would have even used the word community-led growth. We wouldn't even know what that was. But now it's becoming more of a staple of growth strategies from there.
I was just thinking about community-led when you were talking, because boy, did it emerge during the pandemic, where all of a sudden we had no events to go to and we were seeking online communities, peer-to-peer discussions, and really those businesses who staked a place in those communities really are probably still enjoying the fruits of that work.
It's difficult. But definitely it's kind of one of those scenarios that kind of keeps on giving back. If you can build a place that people go to, that's a trusted place of peers that they want to, a lot of great communities people just want to be a part of, right? And then if you can find that balance between wanting to be a part of and then monetization, which is where most communities tend to struggle. Everybody loves wanting to be a part of something until the vendor has to start monetizing it. And then it's like, oh, okay, this feels a little ickier now. There's a sponsor. There's a sponsor we're talking to, or there's more vendor sponsored groups inside of the community and all of those sorts of things. But there is a balance. I think it can be found.
Yeah, absolutely. When all of a sudden there's the community and then there's the premium community and that costs money, it does shift, people's perception a little bit. Exactly. I was also thinking about if you were a business primarily relying on event-led growth, forget it. The pandemic just crushed you. So if your, 2020 marketing plan was, hey, we're going to go to 7 trade shows, boy, you had to shift pretty quick.
And it did. A lot of those dollars and those plans went to digital. And I think a lot of companies saw a lot of great success. I don't want to say it baffles me, but it still baffles me that, the B2B event space is a $24 billion TAM, right? The amount of money spent on B2B events where people are actually going to a place and sitting and doing the conference thing and the hall of vendors and all of that. And like from a cost perspective, there's got to be a better way to do it. Right. You know, the amount of, I mean, just think of the people hours it takes to go to an event. I don't know if you've ever planned an event, but the hundreds of hours you have to jump on calls just to figure out who's going, who's buying tickets, how many, do we have a hotel? Do we have a hotel block? Is it available? What are we bringing? Have we done the creatives? And that's just for a smaller type event. I can't even imagine if I was some of the premier sponsors for some of the premier B2B events that have, you know, 7-figure booths, the amount of logistics that goes into just showing up and time and cost. Hard to imagine that there's a whole ton of direct ROI from that. But again, they keep happening over and over.
Mm-hmm. I almost wonder sometimes if it's the pendulum swing from remote workers who are so isolated, and then they see an opportunity to do an in-person event and they're like, well, that'd be great. You know, I can put on pants, get on an airplane, see some people. So I wonder if that's part of what's feeding it, because you're right. The economies of scale there don't really add up when you're looking at the amount of effort and dollars that go into in-person events. There has to be something else going on there.
And the one thing that no one talks about a lot is there is an entire world of B2B selling and marketing outside of tech and SaaS, right? I mean, if you go on LinkedIn, there's this bubble where everybody thinks the world is just this consortium of technology and SaaS companies, right? But I mean, I have a friend and a colleague who works for a $3.2 billion packaging company, right? With 375 sellers that sell obviously a whole lot, right? But most of those industries are about 5 to 7 years behind tech and SaaS, mm-hmm. right? So they're still doing events because they don't know there's anything else. Mm-hmm. They don't know about intent data and some of the automation platforms and some of the sequencing softwares. I mean, I know companies that are outside of software and tech who use, with their sellers still use Excel spreadsheets. Mm-hmm. Like, this is my CRM. It's a color-coded Excel spreadsheet with names, numbers, and phone numbers. And again, these aren't small mom and pop shops. These are multiple 7-figure companies who are managing their go-to-market via Excel spreadsheet and events.
You know, it was actually quite a blessing. You know, here at Insightly, we're a CRM and we sell to SaaS, but we also sell to manufacturing and healthcare, and finance. And during the pandemic, you know, or even post-pandemic, when, you know, SaaS budgets have been a lot more tight, it's been nice to still have those manufacturing audiences to talk to, because they are still growing and still spending money. So yeah, sometimes we can be in this SaaS bubble, but there are, you know, tons of verticals out there that are still really growing.
Yeah, and really fast. Manufacturing, healthcare, packaging, you know, all of these, I guess you would say, legacy, you know, type. I don't want to, not even technologies, but solutions and there's a whole service, you know, there's a whole B2B services industry that are highly competitive and again, still emerging their go-to-markets and they'll likely be where technology is in probably 5 to 7 years from now. So a lot of the stuff that feels like old hat for tech and SaaS, right? It's like, you know, we'll start emerging into these new markets and they'll start seeing the fruits of some of the labor. And I would assume that a solid part of that B2B event TAM is going to start digitally transforming over the next 5 to 7.
Interesting. So do you think a firm can effectively self-audit its go-to-market motions, or do you think that they need to bring someone in from the outside or have someone, you know, maybe from an outside department? Because it is hard to look at, you know, your go-to-market objectively sometimes.
It's hard. I mean, I think it needs a separate set of eyes, whether that's a different department in a larger company, or, I mean, that really, I mean, most companies in some form or fashion have a board or advisor group, which is really what they're there for, right? There are consultants who do it as well, but, you know, obviously, you know, consultants can be expensive and costly, and things. Not a lot of companies have the budget to just be bringing a consultant in to go through there, but I do think, I mean, again, from my experience, it's really hard to see that sometimes your baby is ugly, right? Like, it's just, you know, so if you've built this go-to-market and it's worked and it's done that, where most leaders fail, especially on the go-to-market side, is they have that, this is my playbook. It's always worked. I'm going to stick to it. Right. And they just get blind to the fact that there might be better ways to do it. And again, myself included, I've had those conversations with myself a lot over the years. Like, is this really the best way to continue going? You know, and then sometimes it is, but you know, I've built a fairly decent job of having that conversation with myself. And I think any go-to-market leader should, right? Is this working? should we start researching other ways, or you even kind of put it out there to your team, like, somebody prove me wrong. I used to do that. That's one of my favorite exercises. Prove me wrong. I think this is the play, but if somebody in this room can prove me wrong in some form or fashion, let's go. Let's have those chats.
Mm-hmm. Yeah. Sometimes when you're in a startup, it's the private equity guys who come in and they audit your go-to-market, even if you don't want them to. So, sometimes that's how you get that type of feedback.
Yes. Boards, investors, lots of fancy, really intelligent people with Excel spreadsheets.
Yeah, exactly. So, you mentioned, auditing. If your go-to-market, like, let's say you have a motion and it's no longer effective, and it's time to pivot to another, what does that look like inside an organization? Because you have sometimes folks who are steadfast in, hey, this is the way we do it. This is what we do. And then you have someone coming over saying, hey, I really think we should add, a partner-led growth strategy here, or a channel-led growth strategy here. Like, what are the change makers inside an organization that would lead that type of change?
I mean, the first thing before any sort of change happens is to identify whether you have a strategy problem or an execution problem. Mm-hmm. I would argue that 75 to 80% of all go-to-market issues are execution focused and not strategy, right? So, and that's where the biggest miss is like, oh, this isn't working anymore. We need to change our go-to-market, or we need to change a motion, or do something completely different. Really, something happened in the organization to where you just stopped executing it well. So that's the first thing I would do, is audit execution and or strategy. And again, 85% of the time, my contention is you'll find execution issues over strategy that you're going to want to do. Should you have to make the change, you have to realize that it can't be instant. Like, there has to be a progression, because the most of the time your challenge in go-to-market motion changing is the talent that you have in place. If you've built a go-to-market motion all on outbound, you can't just magically hit the inbound button with a bunch of people who have no experience in inbound. Same thing, you can't just magically hit the channel button with someone who has no experience in building and or running a chain. Like, generally, humans in the go-to-market world tend to specialize in one of the above, right? Again, it's things like product-led, right? Like, somebody who doesn't know what they're doing in a product-led motion can go really, really awry and spend a whole lot of money without a lot of return, right? So just the transformation of your staff, right, to have the right people in place to execute the new motion will take time, right? And I think that's the biggest most executives miss too. Like, oh, I'm reading about this product-led stuff. We should do that. Okay, great, cool. We don't have anybody here who does that.
Yeah, or we don't have a strong product that, that motion is just not going to work for us. So that leads me to my last question. I feel like it's the big question that everyone always asks. Is it the CEO that owns go-to-market? Like, who at the end of the day calls the shots?
I would think so. I think that your CEO is the chief growth officer, the go-to-market leader, all these fancy titles that are popping into the market now. Like, there has to be a singular person who looks at the entire picture across. Can we afford it? Do we have the people to do it? Do we have the culture to do it? Do we have the time to do it? Does it align with the long-term goals of the organization? You're never, like, every individual business owner inside the business is going to see a different view of that. And then there needs to be a singular person who collects the data from all individual segments of the business and makes the decision on which way you're going to run. It's collaborative, but I don't believe it's a decision that could be made by consensus and or, there's no way that there's not a lot of CFOs who are going to agree with an increased amount of spend, if the end goals of the company is based on, EBITDA margins and things of that nature. The other thing is, like, compensation and targeting drives action, right? So if there's not somebody who's aligning the compensation and the targeting of your business units across a singular go-to-market, everybody's, chasing the wrong stuff. I had a LinkedIn post this week that kind of speaks to it, that's where most sales and marketing misalignment happens. It doesn't happen because sales leaders and marketing leaders don't communicate well. Most of them communicate really well. The problem is that marketing leader X is targeted on forward-facing metrics like MQLs. Sales leader Y is targeted on backward, end-facing metrics like revenue and et cetera. And there's nothing that connects the two. So marketing person thinks they're doing a great job. They're getting bonuses and raises and target achievements and high fives. Sales is getting the same function, and there's nothing that collaborates them together. So that's where, as a leader, and especially the CEO role, like understanding that what people like, making sure the definition of doing a good job is aligned across all of the units, which will really kind of cements the go-to-market, whether it's changing and or evolving.
That's why I really love talking about go-to-market, because I feel like it does align everybody under the same goals. And I think, Chris, you nailed it. The buck stops here. It's the CEO who has to call the shots.
Yeah, which is difficult because it's getting in the trenches enough to understand all the different motions, and like it's changed a lot, right? And even as you get to the really, really, really large companies, right? When you're trying to manage 5 separate individual go-to-markets that in some cases are $100 million individual businesses of themselves, think of a large IT vendor like a Cisco, like their channel go-to-market is hundreds of millions of dollars of revenue. Their direct-to-customer go-to-market, their inbound, like these are and to have a singular person or group at the top who has to understand all the levels of those and pull them in together is really, there's a reason why it's a very difficult job to do, especially at that scale, because you're really looking at, in some cases, dozens of individual $50 to $100 million businesses driven by completely organic go-to-markets, which is fascinating. I love it. Like that's what those types of puzzles are what wakes you up in the morning, but it's truly a unique challenge.
Agreed. Chris, that's all the time we have for today, but I really appreciate you joining us.
Awesome. It's been really, really fun. Thanks for having me, Val.
Great. And thanks to everybody out there for tuning in. Remember, you want to like this video, subscribe to the channel, ring that bell for notifications so you don't miss an episode, and we'll see you next week on Closing Time.